Hello, and thank you to everyone that is coming through so far. We'll just give it a couple of minutes, perhaps one or two before I begin, just to let everyone arrive. Okay, well, hello everyone, and welcome to today's masterclass. My name is Louisa Gaynor, and I'm a Senior Client Advisor here at Netwealth. And I'm joined today by Gary Horn, one of our Chartered Financial Planners, who sits with me on the advisory team. And today, as I'm sure you're aware, we're going to be talking through the importance of being thoughtful about and optimizing your financial plans. So we're going to try and highlight the tax efficient elements of financial planning, both in the accumulation stage of your life, i.e. while you're still working, and also in the decumulation stage of your life, effectively when you're in your retirement. Gary's going to kick things off with a review of looking at the controllable elements of investing and thinking about the importance of using these to our advantage. He's then going to look at these in the context of the current tax rules and hopefully impress the importance of utilising your available tax wrappers and allowances where possible each year. And how actually, as well, in retirement, a thoughtful drawdown strategy can have a significant impact, not only on the life expectancy of your investment assets, but also on your inheritance tax planning. We'll then move on and I'll provide a quick demo of our online tools, which are free to use and really quite helpful in enabling you to visualize your financial plans. And then we'll think more closely about investment strategies and the importance of having a robust investment framework in place. And hopefully this will provide a good insight as to how Netwealth approaches these points and how we can hopefully help you to achieve your objectives. We've had quite a few questions submitted ahead of the session, so thank you very much for those that have done so. We've done our best to incorporate these into the topics we're covering today. You'll also see that there is a Netwealth team as part of the chat on today's session. So if you do have any questions as we go along, please do direct them there, and we'll do our very best to answer these throughout, and then also if we have any time at the end. And as many of you will know when you registered for the event, you are actually able to book in for a one-to-one follow-up session with one of our advisors. And we've had a great number of you done so already, so that's brilliant. But we thought it'd be a good opportunity in these one-to-one sessions to just talk through your specific circumstances and have any of your immediate questions answered directly. So if you haven't already done so, we're just going to post a link in the chat box now so you can register with us. So please feel free to do so and you can book in the call at a time that suits you. But thank you very much. I hope you enjoyed today's session and I'm now going to pass you over to Gary to start us off.
Yes, good morning, everyone. Thank you ever so much for joining the webinar today. So, first of all, to get started, I'm going to give you a bit of an introduction to the way our philosophy in the way we work things at Netwealth in terms of how clients should be thinking about things. So, the main ways we help clients think about things are the elements that are within their control and the elements that are not within their control. So first of all, if I start on the right-hand side, the elements that are within the client's control. So first of all, we very much think it's important to think about the time in the market as opposed to actually trying to time the market. So it's really difficult to actually try and time the bottom of the market and then equally trying to sell right at the top. So what's most key for a client's financial sort of long-term position is thinking about the actual time they have invested in the market and with the right level of risk. Equally, if you're going to take that approach with clients, you need to have a sensibly diversified portfolio. So at Netwealth, we offer globally diversified portfolios across the asset classes and across the geographical regions. Now, we have 7 different risk profiles, each tailored towards a client-specific objectives, and Louisa will go into that a little bit more in detail later in this webinar. In terms of optimizing efficiency when investing and also in the drawdown phase of a client's financial plan, it's really important to be making use of the available tax allowances for clients. So the UK government there's a limited number of allowances that are available to clients. So it's really important that clients are taking maximum use out of those allowances. So we're talking here about making sure they're making pension contributions, ISA contributions, making sure that when they're in the stage of drawdown, making sure they're making use of their variable allowances, such as personal allowances, basic rate bands, if there's a husband and wife, the tax differential between the husband and wife. So really being thoughtful about the optimal strategy for the clients there. And then lastly, in terms of elements which are certainly within the control of clients, is minimizing the impact of fees. So very much here at Netwealth, we recognize that there will be fees involved with investing, but we certainly are trying to minimize those fees for clients and the impact that will have on the long-term returns for clients. So whether that be the cost for investing or the cost for the financial planning side. So that's the elements that certainly we can control, and we will be going into that in more detail later in this webinar. Now, looking at the items that aren't within our control, now we may not be able to control these, but we can certainly model for them and build them into a sensible financial plan. So looking at market performance, we cannot dictate what the market's going to do, what financial market returns are going to be, but we can certainly model for the range of portfolio returns that a client or an investor may experience, recognizing that there could be weak market returns and then building that into a financial plan to make sure that's fully factored in. Inflation. So obviously this is a very hot topic at the moment, with inflation being elevated over the last couple of years. But even recognizing with a more benign inflation environment, so assuming even if the inflation was down at the Bank of England inflation rate target of 2%, it's really important to factor that in, because even with benign levels of inflation over the longer term, that can have a real meaningful impact on the real value of capital over the long term. So just recognizing that inflation does exist and building that into your financial plan. And then equally longevity. So clearly, people may have a sort of you cannot control how long you're going to live, other than maybe having sort of an element of living a healthy lifestyle, but recognizing that there is information on average life expectancy on the ONS website, the Office for National Statistics, but recognizing there are tail risks to living longer than the average life expectancy, and building that into a financial plan to ensure that your needs can be met throughout the course of your lifetimes. So that's our sort of general philosophy about how we help clients and what to think about, thinking about the controllables and the uncontrollables. Now I'm going to be looking a bit more in detail now about the available tax allowances that are available to clients. Okay, so looking at the current backdrop and regime. Okay, so first of all, I'm just going to take a little bit of a recap in terms of what was announced in the spring budget last year. So first of all, focusing on pension allowances. So just to remind you of the rules, generally speaking, the maximum amount which someone that can contribute to a pension on a tax relief basis is, broadly speaking, 100% of their relevant earnings in a particular tax year. But there's a cap on that, and that cap is essentially governed by your annual allowance. So this was actually increased from the start of this tax year, so the 6th of April 2023. So that annual allowance was increased by 40,000 to 60,000. So that's the maximum cap that someone can put into a pension or using their allowance. But again, you have to have the relevant earnings to be able to sort of base that on. Also, just to let you know, you can also carry forward annual allowances from 3 tax years back if you're a particular client in that position that you're maxing out your annual allowances. So yeah, you can bring forward any unused allowances, factoring in the previous contributions that you have made. Another increase which was made from the start of this tax year was the increase in the money purchase allowance. So that was increased from £4,000 to £10,000. So the money purchase allowance is the annual allowance which is applicable to those clients who have already started drawing down income from their pension. So whilst not a huge amount, it's obviously it's helpful that that has been increased. Um, Furthermore, in terms of the announcements, I guess the biggest ones which were announced at the start of the tax year was the forthcoming abolition of the lifetime allowance. So from the start of this tax year, the 6th of April 2023, the lifetime allowance still existed, so it still exists as it currently stands for this tax year. But what was brought into immediate effect was that the LTA tax charge was set at 0%. The reasons why that was done is because it was going to require legislation to actually write out the LTA. So from the 6th of April this year, so at the start of next tax year, the lifetime allowance is going to be completely abolished. So that will no longer exist. Um, However, what's worth noting is that the tax-free cash has been frozen. So that's the maximum amount which someone can take when they're accessing their pension. So broadly speaking, it's 25% of their pension pot, subject to a maximum of 25%. Sorry, subject to a maximum of 268,275. Now that just so happens to be 25% of the prevailing lifetime allowance. So as much as the LTA has been abolished, there are still sort of elements to it which sort of are sort of being sort of pulled over to the new regime. Um, and finally, just to mention on that, if for clients that do have forms of pension protection, so any forms of fixed protection, their maximum tax-free cash will also be pegged to that enhanced protection, so 25% of whatever fixed protection they may have. Also, in terms of other elements which were increased, is the point which tapering begins on the annual allowance. So just to remind you, for very high earners, for those with earnings over 260 of adjusted income, the annual allowance of 60,000 is tapered down. So that's tapered down for £1 of every £2 of adjusted income above 260. So that such that the annual allowance of 60,000 is reduced by a maximum 50,000. Therefore, that will result in a fully tapered annual allowance for those individuals of £10,000 rather than previously £4,000. So that's basically obviously relevant for very high earners, but even though only a small increase, it is obviously useful to be able to put an additional amount into pensions. Now, looking forward to 24-25, so recently announced in the budget was a reduction in the employee and national insurance rate from 10 to 8%. So that's building on the reduction which was took effect from January. So that is been estimated to impact around 27 million workers. That's going to save them £450 a year. So that's obviously helpful. The other relevant rate which was reduced was the high rate tax for property. That CGT rate was reduced from 28 to 24%, and that's effective from the start of next tax year. There was an announcement that the non-dom status is going to be abolished, effective from 2025. So just a sort of a reminder of those rules. Non-dom status essentially means that someone can make an application such that on a remittance basis such that they only pay income when it's brought back to the UK. So those rules are going to be changed. Essentially, it's going to be based on some residency-based status as opposed to non-dom. And one other key announcement which was announced in the recent budget was the potential or future introduction of the British ISA. So that was an announcement where there would be an additional allowance of 5,000 into a British ISA. So the normal ISA allowance being 20,000, and in addition to that, there would be a British ISA allowance of 5,000. Now, this is just a consultation that's going on at the moment, so we don't know what the very specifics are. But obviously, as a company, we will be looking to introduce that, and that's obviously helpful for investors to be able to put an additional £5,000 per year each year into an ISA. So there's the backdrop of the what was announced in the spring budget last year and what we can look forward to in the tax year ahead. Um, so just to give you the backdrop in terms of the changes that were made, and all of these changes are actually going to be remain the same for 2024. So we've got essentially a personal allowance of 12,570. Your basic rate band goes up to the element of taxable earners of 50,271, and then your high rate tax threshold is up to 125,140. Above that is where the additional rate tax kicks in. Other relevant allowances just to sort of draw your attention to. So there's been a gradual reduction in the CGT exemption. So last tax year it was 12,300. It's now currently 6,000. There's going to be a further reduction in that to £3,000 from the start of next tax year. There's also a similar type reduction in the dividend tax allowance. So it's currently £1,000, and that's going to be reduced to £500 from next tax year. Okay, so just moving on to the utilising tax wrappers and allowances, and just to give you an idea of the sort of planning that can help clients. So essentially, first of all, let's look at pension contributions. So pension contributions remain one of the most sort of tax efficient vehicles for clients to be saving for retirement. So just to remind you, if you contribute to a pension, you get tax relief on the way in, and then on the way out, you generally have the ability to take 25% as a tax-free lump sum, with the residual being subject to income tax. So, in terms of, and obviously those funds within the pension environment can then grow tax-free. So given the tax relief, they remain a very tax efficient vehicle to help save towards retirement. So what should clients do about this? Well, I've already mentioned there's particular tax brackets for different clients. So just for example, if we target the that part where you're additional rate taxpayer with the sort of earnings over 125, clearly that's getting tax relief at your additional rate tax. There's also that bracket where if you're within the 100,000 to 125,000, where you start to lose your personal allowance. Now that's quite a sort of a very good area for those particular clients to be making pension contributions, because by doing so you get to sort of reinstate your personal allowance. So what should one do when sort of thinking about pension contributions? So as I've already sort of mentioned earlier, in terms of the maximum amount which you can contribute to a pension, it's based on your taxable earnings, but being aware of your available annual allowances. And Louise will speak about this later on in the webinar, but we offer financial advice if someone's not quite clear on their ability to be able to contribute to a pension, and they need help in order to work out what available allowances they do have. And this also includes going back to those previous tax years to understand what available unused allowances you may have. So now moving on to ISA allowances. So I've already mentioned about the availability of each investor, each client, to have an annual ISA allowance of £20,000. So it's remains a really important way to build up tax efficient savings. We've actually had a question that was asked regarding the lifetime allowance as well, whether using a lifetime ISA or investing in one, it makes sense. So as with all of these things, we've got our different pots and different buckets and different allowances that are available to us as UK investors. In terms of the lifetime allowance, so just a reminder of the rules, if you don't know, is We have the ability to also invest £4,000 into a lifetime ISA. And what happens there is the UK government then adds a bonus of £1,000 onto that amount. That £4,000 though does make up part of your total £20,000 annual ISA allowance. The main things to be I guess to answer the question posed by someone is it can make sense to use the lifetime allowance, but it's just being aware of, okay, you do get the bonus, but there are restrictions in terms of accessibility, in terms of, and the main ones being they need to be used for a first time property purchase, or they cannot be accessed until age 60. If you do not adhere to those rules, there is then a penalty, which basically more than claws back the bonus you have received. So it's just being aware of those things, but absolutely they can be a useful tool for certain individuals. In terms of I've already mentioned the British ISA. Um, we don't know we don't have the full details. It was just announced in the recent budget that the government would be looking to introduce one. We'll obviously be monitoring these developments and hoping to launch that at the appropriate time as well. Um, in terms of CGT, so I've already mentioned that the CGT exemption has been cut on numerous occasions, set to be cut again from the start of next tax year. So the main thing being really, what can clients do in terms of planning? Well, first of all, absolutely making sure that they do use that exemption each tax year. So here at Netwealth, we have a tax allowance service which is available to clients, which essentially targets using that exemption each tax year, if it's not already been used through like natural investment decisions by our investment team, such that towards the end of the tax year, we will make certain investment changes which will target using that exemption. Now, as much as it's not huge, it still makes sense to be using it because it cannot be carried forward to future tax years. So rebasing your base cost of your investments, that's obviously going to save on future tax. Now, the IHT nil rate band of 325,000 per an individual. Now that's been frozen for many years now and set to be frozen until I think it's 2028. So just bearing in mind that more and more people that are being pulled into the IHT sort of that needing to pay IHT on their estates. So one potential consideration for clients is to be making gifts such that those growth in those assets is then outside of their estate for IHT purposes. So I hope that is all clear. Okay. Okay, I'm just going to use an example here now in terms of effective use of ISA and junior ISA allowances. Okay, so what we've got here is just a reminder. We've got an annual ISA allowance of per an individual for an adult of £20,000 per year. The maximum junior ISA allowance is £9,000 per year. So what I'm really just wishing to illustrate here is the meaningful impact of tax efficient saving and what that can have on an investor. So on the left hand side, we've got £500,000, okay, and that is invested into the Netwealth risk level 7 portfolio. So that's a high risk portfolio, predominantly equities, and that is invested in a general investment account, okay. So that a general investment account is a taxable portfolio, so it's not one of the tax efficient vehicles that pensions or ISAs, but it is after using the allowance, it is a good way of investing funds. So on the left-hand side, we've got a client who's just invested in a general investment account, no tax wrappers, and what we've done here is project forward what their position will look like in 10 years' time. So for this particular client, in 10 years' time, risk level 7, that portfolio is going to be worth £645,000. Okay, and now conversely, on the right-hand side, what we've got here is an illustration of the impact of tax efficient investing. So what we've got here is a client, instead of just investing the funds in the general investment account, each tax year they are making use of all of the family's ISA allowances and junior ISA allowances. So 20,000 each per adult, so husband and wife. In this particular scenario, they've got 3 children, so they're able to put 9,000 a year for each of those children into the junior ISA. Um, and what this is basically illustrating is just by the same investment strategy, the same fees, everything remains the same, but all that's happened here is in this particular scenario, the client is investing in a tax efficient way. And essentially what we've got here is at the end of the 10 years, it's worth 730,000 instead. So really the main point really to be sort of bringing up here is whilst our available annual allowances aren't huge, it's really important in terms of this. I mean, this is just over 10 years, just to demonstrate how much of an impact that can have on the client's end position. So just to illustrate the point here, so what we've got is the general investment account starting at 500,000, being drawn down over the year to fund the various allowances. So basically 20,000 going into each of the adult ISAs here, £9,000 going into the junior ISAs for the children each year. Okay, so this next slide is just to give you an idea about a certain particular example, which we've used on quite a few occasions, but just to show how um, um, considered financial planning can have a real meaningful impact on the client's position. So, and this is just a particular example of a certain area of financial planning, how we can help. So, in this particular scenario, we've got a client. Her name is Annabelle. She's age 65 and she's just retired. Okay, so she has a pension pot of £1 million. Okay, and what she's actually done is she's just crystallised that pension, i.e., taken benefits, and what she's going to do is basically immediately take the 25% tax-free cash available from her pension and then reinvest into a taxable general investment account. Okay, so that's going to leave her essentially with the residual 750,000 in the pension and 250,000 pounds in the general investment account. Annabelle, her retirement requirement is 3,500 per a month. Okay, and she's going to invest all of her portfolio, so both the pension and the general investment account, into a Netwealth risk level 5 portfolio. So it's a fairly sort of moderate to adventurous portfolio with 60% in equities and 40% in bonds and cash. Now, she's going to use her ISA allowance, so just it's similar to the previous illustration that I'd provided. Use her annual ISA allowance for tax efficiency by moving £20,000 per year from the general investment account into her ISA portfolio. Okay, and in terms of Annabelle's objectives, she has a primary objective, which is essentially meeting that 3,500 net income requirement each month. And then her second objective is to leave assets to her 3 children. So what we've got here is an illustration of one strategy which Annabelle could adopt. Okay, so in this particular scenario, so Annabelle's age 65. This particular wealth projection, it's run to age 95. So typically when we're building financial plans for clients, we do generally run those to age 95 as a sort of prudent base case scenario, just to, again, going back to the beginning, just ensuring that clients' needs can be sustainably met throughout the course of their lifetimes. In this particular strategy, what Annabelle has done, she's basically drawing, meeting that income requirement by purely drawing down on the pension in the first instance. So she's basically going to have a personal allowance to use. She's then obviously going to be subject to tax on any excess of that on an annual basis. Once she has then fully depleted the pension pot, she's then going to be using her general investment account or ISAs when the general investment account has been depleted because it's funding the ISAs to continue to meet her needs through the rest of her lifetime. So what we've got here is at the end of the projection, age 95, we're showing that Annabelle has 330,000 remaining on in her wealth investable assets, and actually that's all within the ISA. So that's continued to grow tax free. And so in this scenario, it's a good outcome for the client. They've met their primary objective, met their needs, their 3,500 income requirement throughout their lifetimes, and they've still got meaningful assets to be able to pass on to the three children. So that's great. However, the next scenario is just going to give it an alternative illustration with an alternative drawdown strategy. So in this particular wealth projection, what we've got here is essentially what Annabelle is going to do. She's going to meet her requirement by drawing down, first of all, from the pension, but only such that she is using her basic rate band. So she's avoiding the scenario where she's drawing income, which is going to be subject to high rate tax. If there's an excess of her requirements, she then actually supplements it by drawing down on her general investment account or ISA portfolio. So, and then once the clearly the GIAs and ISAs are depleted, she would then flip and start using her pension portfolio again in its entirety. So what we've got here is all other aspects are exactly the same as the first drawdown strategy. And what I mean is she's adopting the same investment strategy, again, being invested at the net wealth risk level 5 portfolio for this modeling. Fees are all the same. Just by changing her drawdown strategy, there's been a significant improvement in terms of the end position. So rather than the 330,000 at age 95, we've now got a scenario where there's actually 683,000 left at the end of the projection to pass on to the children. So she's made a material difference in her position, but just by altering her retirement strategy. And these are the sorts of things that we absolutely can help with in terms of when we build financial plans for clients. Not only is there additional wealth remaining at the end of this particular wealth projection in the scenario two, is the other key thing to mention is all of these assets are now actually within the pension, as opposed to in the previous scenario when they were remaining within the ISA. Now, the main relevant point for that is that pensions are outside of your estate for IHT purposes. So in terms of sort of ticking both boxes in terms of meeting Annabelle's needs, she's succeeded in doing that. But the second scenario is far more optimal in terms of her secondary objective of passing on assets to her children. So in terms of I guess sort of making sure people are making use of their various allowances. This is just one particular example where good financial planning can make a meaningful impact to clients' positions. But there's various other strategies depending on the client's situation. So, for example, we had one question that was posed to us before the webinar is making use of as I guess like husband and wife's different tax differentials. So if one was a high rate taxpayer, one was a non-taxpayer, then absolutely it can make sense to be firstly investing in different proportions to make sure that you're making use of the tax differentials, but also when it comes down to drawdown strategies, being fully mindful that there is a different tax status between the individuals. So this is just an idea of the sort of things that we can do and help with. Here we help our clients with. but it can have a real meaningful impact if you thought about your financial planning. So next, I'm going to pass on to Louisa. So she's going to first of all go through some of the various online planning tools which we have available to clients, which can also help with their financial planning. So I'm now going to pass over to you, Louisa.
Thanks, Gary. Yeah, so I thought, as you said, I'd change it up slightly now, and just do a quick demo of our online tools, as these can be a really helpful way of just being able to visualize your financial plans and get an indication as to where your investment could grow to over your time horizon, but also importantly, if you're on track to achieve your goals. So hopefully what will we put in the chat box of the webinar at the moment is a link to register with us, because by registering with us, you can access these tools. They're free to use. It doesn't commit you to opening an account, but they really are the best ways to drill down not only into our portfolios, but as I said, your financial plans as well. Although it's a bit of a repetition here, I thought I'd do another case study just to really illustrate that for you. So we're going to look at an individual here who's focusing on their retirement goal again. And we're going to say that this individual wants to target £60,000 per annum of income from their investment assets. So it may well be that they have state pension entitlements, DB pension entitlements that provide them with some income throughout their retirement, but they'd like to top this up with draws from their investment assets. So £60,000 per annum equates to £5,000 per month. And as Gary mentioned at the beginning of this session, it's really important to factor into your modelling the elements of investing that you can't control, such as inflation. So whilst inflation is very high at the moment, we would expect that over the course of the next year, and certainly over the course of your retirement, that this inflation rate is going to settle somewhere around 2.7% per annum. So we're going to bake that into this projection here. The client we're thinking of at the moment is 50, and they would like to retire at the age of 65. So that's 2 years before their state pension will come into play. The target length of retirement, again, another element of investing that we can't control. It's really asking just how long we think we're going to live for. We usually, within our financial plans and within the advice that Gary and his team provide to clients, look at modelling until the age of 95, just to hopefully then remove that risk that you're going to outlive your investment assets. So I'm going to put a 30-year time horizon in here. Now, within these modelling tools, we can only look at one specific account type. We do have our more intricate cash flow modelling that can be done in-house with the advisory team, where you can look at a number of different account types. But for this, we're going to assume that all funds are within the pension, whereas in reality, it may be that they're spread across pensions, ISAs, and general investment accounts, all that have been built up whilst this client continues to work. We're going to assume that their combined investment assets, so across all those account types, is around 600,000 at this point in time. And whilst they're still working, so for the next 15 years, they're going to be making regular contributions to their pensions and their ISAs. We've already heard from Gary how it's so important to keep these topped up consistently and throughout your working career. So we're going to assume here that this client tops up their pension to the maximum amount, and they are tapered to contributions of only £10,000 per annum. So that equates to £833 per month. But they're also topping up their ISAs to 20k per annum, which equates to £1,667 per month. So their overall monthly contributions to their investment portfolios are £2,500 per month. And that's going to be the gross amount. So then you can see here we get to choose the risk level. So Gary's already alluded to the fact that we have risk levels 1 to 7, and I am going to come on to these in a bit more detail in a moment when we look at our investment approach. So I'm not going to spend too long now drilling down on them, but for the purpose of this case study, similarly to what Gary said, we're going to use a risk level 5 portfolio. So that's effectively our 60-40 portfolio. You can see there 60% in equities, 40% or just under 40% in fixed income, with the balance in alternatives and a little bit held in cash as well. So again, this information is all there for you to access by just registering with us. So you can really drill down as to what exactly is in each risk level portfolio. And these two charts here in the middle and on the right are designed to give you just a bit more of an indication around the risk return characteristics of the portfolio. And again, if you book into one of our one-to-one follow-up sessions, if it's relevant and you're interested, we can certainly go through these tools together and spend a bit more time on them. But for now, I just want to go to generating that projection. So being able to visualize that financial plan. So is this goal of targeting £60,000 of net income per annum in my retirement achievable? And what we can see here from this projection is that there's a good chance that I will be able to achieve that goal. I'll be able to meet that income requirement and still have money left over at the age of 95. In what pots, that will depend on your drawdown strategy, as Gary's already said earlier. So it's really important to be thoughtful around that as well. But what we're looking at here in the chart is the potential range of performance outcomes if you were to experience strong, average, or weak market return scenarios. So if you were to experience strong market return scenarios, which assumes average annual returns net of fees of 6% per annum, then you would meet that income requirement throughout your retirement, and you'd actually have just over £2.6 million remaining across your investment assets. In average market return scenarios, which assumes average annual returns of 5.1%, that amount is slightly or significantly reduced here, and you've got just over £35,000 remaining in the investment pot at the end of that time horizon, so by the age of 95. So some people may think that gives them sufficient confidence that they're on track to achieve their goals, and they don't see too much issue in that. Others may feel, okay, well, actually, I'd like a bit more security that this money is going to last me to the age of 95. And so they may want to think about, okay, well, what happens if I delay my retirement? Maybe I delay it until state pension age, because that then is 2 more years of contributions and 2 less years in which I'm actually drawing on my investment assets. So let's just have a look at the impact that that will have on our overall plan. It's really helpful in terms of just understanding the variables. And what we can see here is the chart does actually look significantly different. And now, even in average market return scenarios, I'm meeting that income requirement, and I've got just over £1 million remaining at the age of 95. So it's quite a helpful way of being able to think about these things more carefully, and certainly as you're building up your pots in the accumulation stage of your life. But again, very happy to go through these tools with anyone when we have our one-to-one sessions or following on from that. And Gary and his team have much more kind of intricate models that they can do with clients as well. But it just hopefully brings to life how the technology can enhance and help you to visualize your financial plans. But I'm now going to go back to the slides, as I just want to have a quick look at our investment approach before I just double check whether any questions have come in. So I'm just going to change my screen sharing here, and we're going to have a look at how the team have built out and managed our portfolios through time. So I just wanted to start with this slide here, which brings to light the point around diversification. That's something that Gary mentioned earlier, and how it's one of the controllable elements of investing. And it should always really be the first level of protection for any investment portfolio, to ensure that there are a number of different assets which have different drivers of return to help smooth out that investment journey. So what we're looking at on the screen here is what we call a market quilt. And that's really just because of the wider array of colours that you're seeing. And hopefully the first thing that you can tell when you look at this is that there is very little pattern to these colourful blocks. What you can see here is that in every year from 2007 right to the end of 2022, we have ranked the different asset class returns in order of their performance. So the higher the asset class appears on the chart, the better it performed in that specific year. And what it hopefully shows is that it's very difficult to know what any given asset class is going to do in any given year. What we can see is that there are certain relationships that hold true between the different asset classes. So if, for example, we look at commodities, which is in that light grey box there, when it's underperforming and towards the bottom of the page, emerging market equities in the pink box tend to do less well than developed market equities in the blue-green box there. And that's a theme that tends to run through time. And if you look closer, one of the most important things to note about this chart here is that you should be able to pick out a white box that says portfolio in them. And that reflects the Netwealth Risk Level 4 portfolio, which is our balanced portfolio. And we've included this performance rating here on a simulated basis over these years so that you can see how it's performed in the context to other asset classes. And what you'll hopefully note is that the box never sits at the top of the chart, but equally it never sits at the bottom of the chart either. And so really importantly, it provides that level of certainty that you're just not going to see those extreme movements of up and down in your portfolio returns, because you've got a lot of different drivers and what's impacting the performance over time. And that's the whole point about diversification and why it's very important that it's embedded within your portfolio. And I just wanted to touch on now how the team actually manage our portfolios to ensure that they do remain globally diversified, but while also factoring in the sub-asset classes to hold within the portfolios at different points during a market cycle. So there are 3 points to the Netwealth investment approach, and you can see them in these 3 pillars here. The first and the biggest contribution to the risk being taken within these portfolios and the return being generated is our strategic asset allocation. So this represents our view of what the best mix of asset classes are for a given level of risk. If you were to invest in a portfolio and come back in 20 years' time, this would be our best estimate as to how you should be positioned. Overlaying this, however, we think it's really important to keep a view on how different asset classes change through time. And so over on the right-hand side, you can see here how we think about the cyclical positioning within our portfolios. So looking at things like the macroeconomic, policy, and fundamental data, to make small adjustments to the currency, sector, regional positioning within the portfolios, for example, just to smooth that path of returns for clients. And Gary, at the beginning of the session, also briefly touched on the importance of keeping fees down. And cost efficiency forms part of our investment approach as well. And we employ this with regard to the instrument selection we choose. So we primarily use passive instruments within our portfolios. They tend to be exchange traded funds that track in indices. And this is instead of us trying to pick specific stocks or active fund managers. And a key factor to this decision is that it just keeps the ultimate cost to clients much, much lower, while still hopefully achieving a good level of diversification and liquidity within all the portfolios that we manage. And so here what we're looking at are all 7 of our sterling risk level portfolios. So you've got risk level 1 on the left-hand side, all the way across to risk level 7 on the right-hand side. And you can see in the lower risk levels, these portfolios have a much higher exposure to assets such as cash, money market funds, and fixed income. But as you move across to the right-hand side of the chart and the higher risk levels, this exposure reduces in favor of equities. And you can see that risk level 7 on the right-hand side there has over 90% in equities and only a much smaller exposure to alternatives in the orange there, and a nominal cash position as well at less than 1%. Conversely, on the left-hand side with risk level 1, this is predominantly made up of money market funds, and with the only bond exposure there being very high quality, very short-dated corporate bonds. So there's a real extreme in the characteristics of the 2 extreme risk levels that you're seeing there. And then just dropping down to the chart below, or the bar charts below, what we're looking at here is the currency exposure within our portfolios, because we like to think of that separately. And as we move up the risk spectrum here, we're transitioning from a predominantly sterling-based portfolio to a much more diversified portfolio mix. And this is always done on a really thoughtful basis. So, for example, at a strategic level, we've been pretty unsure as to whether at this point in time, euro currency exposure would provide any added benefit to the portfolios at all. And so whilst we think it's important to have exposure to European equities and we invest in them, we do this on a currency hedged basis. Whereas with things like our US equity position and our Japanese equity position, we leave those spots unhedged so we can get exposure to those currencies because we think they add some benefit to the portfolio as defensive asset classes. And then just to drill down a little bit further to this, although I appreciate it's quite a busy screen, what you're looking at here is a much more detailed breakdown into the asset allocation and currency exposure within our risk level 4 portfolios. So what's hopefully made particularly clear by the 2 charts on the right is that this portfolio, and in fact all portfolios, are made up of a number of different asset and sub-asset classes. And you can see these again for each portfolio with the online tools that I showed you earlier. And the bar chart at the bottom just shows as well the currency exposure, whether we choose to leave things hedged or unhedged, and what it is for this specific risk level, so risk level 4. So even though we are investing on a passive basis and we're using those exchange traded funds within our portfolios, there is a good level of granularity to provide intended exposures in really efficient ways. And the mix of these asset classes will absolutely change through time, but the overall aggregate risk of the portfolio is going to be consistent and true to that of the risk level that you chose when you invested with us. And so I just wanted to touch on now a few examples of how different asset classes have different drivers of performance and why it's important to have a combination of these within our portfolios. So here we're looking at the performance of UK fixed income during periods of stress in the equity markets. And we're looking at the years 2004 to the end of 2023. And in each bar, the area that is blue shows the biggest intra-year drawdown for the equity market in that specific year. And the area that is grey shows the fixed income return during that drawdown period in the equity markets. So what we can see here is that, generally speaking, during periods where the equity markets come under stress, the bond market tends to strengthen and therefore mutes, at least to some degree, the level of loss that we would see in the overall portfolio. And this is particularly apparent if we look at the center of the chart. And if we look at the years, for example, from 2007 all the way across to 2020, we can see that that really does stand true. And it was an added benefit to our portfolio during that time. I know more recently in the years 2021 and 22, which we can see here towards the right of the chart, we had almost unprecedented experience in the world of investments, insofar as we saw a positive correlation in moves within the bond and equity markets during these periods of extreme stress. Both of them experienced periods of significant drawdown in those years, and it brought into question for a lot of investors the value of the 60-40 portfolio. Should I still be having a mixture of bonds and equities? Does that still provide me with sufficient protection? However, what we can see, and even in 2023, and certainly in the first quarter of this year, is that the relationship between these two asset classes has actually started to right itself. The bond markets have reset, and we are seeing the added value that they have within our portfolios again. And it's certainly something that we think will remain true throughout a market cycle. And so we're not just going to have these knee-jerk reactions to specific periods in time where elements of the portfolio start to perform poorly, but we're going to take a more long-term view as to where we think we can position the portfolios best throughout a market cycle and to harvest those returns for clients. And I just briefly wanted to touch on here another good example of the importance of diversification and how looking at different equity markets have performed in comparison to one another. So what we can see here is that since the global financial crisis, the performance of US equity markets, which is shown in the lighter blue there, has really dominated all asset returns and has outperformed emerging markets, which we can see here in the darker blue. What we can also see, however, when looking at the returns for emerging markets, is that it really is a high growth area. There are often periods of sharp growth followed by dramatic dips. The path of the returns for US equities, however, generally speaking, runs much, much smoother. So what it shows is quite nicely is that there is an importance to having exposures to both reasons because they're not acting in the same way. And so it's important not to commit to one or the other, but to have an exposure to both within our portfolios. The weighting of that is something that will be decided by our team here and is reviewed on a regular basis. But it is important to consider these things and to factor them into your investment approach in order just to mitigate that risk and to take opportunities where we see them in the markets as well. And so finally, just before we close and we address any final questions, I thought it'd be quickly quite helpful to provide an overview of how we do things at Netwealth and a reminder of some of the elements of the fees, particularly towards the advice area that Gary was covering earlier. So just to take it back a step and provide a bit of background to Netwealth, we were founded in 2016, and really we were founded with the aim of bringing modern technology alongside the best bits of traditional wealth management to deliver a service that was both fit for today and available to many more clients. So we absolutely understand that there can be no replacement for people and their expertise, and that absolutely still remains at the very heart of what we do. We have a team of expert investment managers that are managing the portfolios that I showed you a moment ago. And we have Gary, myself, and a team of experienced financial advisors who manage our investment offering and are on hand to speak with clients whenever they would like. But where we would really differentiate ourselves is with the powerful technology that we have, which I've shown you earlier, or at least an element of it, which is designed not to replace these people, but just to enhance the client experience. It hopefully increases transparency and accessibility for clients in terms of understanding exactly what they're invested in and how they're able to monitor their financial plans through time. This technology helps us to deliver this service at a much lower cost, but with no compromise on the quality of it. And I think this can be seen in our track record and our consistent support from the leadership team and our clients, which has been really positive over the last 8 years since we've been going. And just to draw things to a close, we've had a couple of questions around financial planning and that offering there. So I just wanted to briefly highlight our fees here, which is something that Gary and his team do lead on. So whilst clients can speak to an advisor at any time to talk through their financial plans and thoughts for the future, and that's completely free of cost, if they would like to receive formal financial advice, we do have a number of different options available that are shown on the screen here, and these can be picked up at any point throughout the relationship. So I'd be very happy, or any of our advisors would be very happy to run through these in much more detail in the one-to-one follow-up sessions. But this is just to note the services that are available to you and the associated costs. So many clients may choose to pick up one-off or ongoing advice as they approach retirement, for example, with the ongoing advice piece, maybe for those that are more concerned about their financial plans, have more complicated affairs, or think there are a lot of moving parts. Our advisors would then set up biannual review meetings where they could discuss the advice on an ongoing basis. Some clients, however, think that wouldn't be necessary, and all they require is a one-off piece of advice to ensure they have a robust financial plan in place at the beginning of their retirement. Or it may just be at specific points whilst they're still working that they'd like to take advice around pension contributions. We've already heard from Gary the importance of maximising those, but also understanding what you are able to contribute to them. And so that is something that we can do for you here for a fixed fee of just £400. And again, clients often just want specific advice around accessing their pensions and drawing on those. So again, there's a one-off advice package we can offer there as well. And more recently, actually, we've developed a new service of financial guidance. And this is really for clients that think financial advice is not relevant for them at this point in time, but they would like to take a financial MOT. And often clients think actually they'd like to do that on an annual basis. It's where they can speak with a qualified financial advisor who will help them just sense check their existing investment strategies and their financial plans. It tends to be really quite a valuable offering for clients who want a sounding board to the plans they have in place at the moment and to ensure they're putting themselves in a good position to achieve their goals, whatever they may be. So certainly, again, happy to discuss those in our one-to-one follow-ups, or please do feel free to email the advice team at advice@netwealth.com if you have any questions around that. But before we draw the session to a close, I'm conscious of timing here, so I'm just going to put up on the screen a summary of hopefully what we've covered today, and I appreciate it was quite a lot. Hopefully we've managed to provide you with some insight on how you can optimize your financial plans, thinking about those tax allowances and wrappers and managing risk within the portfolios. And if you would like to discuss your specific circumstances in more detail, please do book into our one-to-one follow-up sessions, and there should be a link in the chat box at the moment. Um, but just before we close, hopefully, Gary, you're still with me on the call, and I just wanted to double check if any questions had come through whilst we're here. So have you noted any?
I have myself, no. So we could just have a quick
Oh,
look.
I can see here that one's come through. We've had a question of people asking if they don't have any earned income, what is the maximum amount that they can contribute to their pension? Do you want to take that one, Gary?
Yeah, yeah, of course. Thanks, Louisa. Yeah, very good question. So I mentioned earlier in the webinar that it's based contributions based on your relevant earnings, earned income. But for a non-earner, the maximum contribution that someone can make is £3,600 pounds gross. And just as a reminder, when you're making a pension contribution, a personal pension contribution, you pay that net of 20% tax. So that 3,600 would be funded with a net contribution of 2,880.
Thank you. And there's just a follow-up question to that hopefully you can take as well, which is saying, is it worth doing that for people who are retired?
Uh, yeah, absolutely. Yeah, I mean, in terms of, I mean, obviously it depends on their specific situation, but in terms of, I think there's twofold really in terms of the benefits of contributions. Is firstly, you still get that basic rate tax relief, but in addition, I mean, depending on the overall situation, pensions are outside of the estate for IHT purposes. So it could well be that for this particular client, if they're never going to need sort of to use their pension assets for their own needs, pensions can become a very useful estate planning tool. So generally speaking, yes, it can be.
Perfect. And I can just see we've had another one in here about the process for transferring pensions, which I'm happy to field, insofar as most clients, rather than setting up pensions with us, are moving them across from other providers. And we have a whole team here that can manage that process for you. So it would be a case of sitting down with an advisor, myself or Gary, for example, designing the investment portfolio for the pension you'd like to have with Netwealth. So choosing which risk level or combination of risk levels is most suited for you based on your objectives and things like that. And then once that's set up, you simply authorize us to contact your existing provider via an online form to then bring your pension assets across to Netwealth. And we'll do that by liquidating the pension with the existing provider and bringing the cash across, where we'll then invest it in the pension portfolio and within the investment strategy that you've set up with us previously. So hopefully all the kind of heavy lifting and the admin of it all can be done by our team here. And it's a very similar process for ISAs as well. But I'm conscious of time here, so I think I'll draw the session to a close now, if that's all right with you, Gary. And just to thank everyone for joining today. We really appreciate you taking the time, and hopefully we'll see many of you in the one-to-one follow-ups as well. So thank you all. Happy Easter, and enjoy the rest of your days.